Welcome to Limit Up, the weekly capital market podcast. My name is Don Collins. I'm a chartered accountant and business advisor of 30 years and a partner at Findex, a leading financial advisory and accounting services firm based in Australia and New Zealand. I'm here today with Ian Reynolds, trader and investor, former bank foreign exchange market maker, early investor in Bitcoin and tech founder. Welcome back, Ian.
Thanks, Don.
We're also here today with Mike Smith. Mike is involved in the financial markets. Mike, I'll pass over to you for you to give us your 30-second spiel on your background.
Yeah, thanks, Don. Yeah, pleasure to be here today with you. So I'm now retired, but I'm an ex-professional investor specialising in global fixed income markets. I worked in the City of London for 35 years in that area. And lastly, my job was head of fixed income at the Q8 Investment Office in London, managing all their fixed income assets. And I was there for 18 years. So I keep a keen interest in markets and developments since I retired.
Wonderful. It's a wonderful background, Mike, and we'll probably throw over to you at the end after we've gone through today's press release and maybe get you to ask some questions for Ian at the end. So thank you for that background. Making money in stressed capital markets is tough. A typical investment portfolio will often fail. The world is moving into really challenging times as the US tries to address $39 trillion in debt, contradictory fiscal and monetary policy, internal conflict, and numerous wars. And the rest of the world starts to consider a new global reserve currency, a multipolar world, and aging demographics. So how can we understand what's going on in geopolitics and macroeconomics? Luckily, Ian is here with Siberia Capital's latest press release. Ian, Warsh sets the tone and markets tumble as the Fed chair extols virtue of transparency and accountability. Please explain where Kevin's at the moment.
Yeah, so markets were, I would say, quite shocked by hearing some good stuff for once from the Fed. I mean, we've had 30, 40, 50 years of them not being any of those things. So, what are they going to uncover? Well, unfortunately, he then ruined it all by saying, there's a committee for this and a committee for that and a committee for something else, and we'll all be going down the road. But it looks as though I would say that we're going through a credibility package backed up by Trump saying that the money he stole from Iran isn't his, it's theirs. Wish he'd said that about Russia 3 or 4 years ago. And I would suspect that now we've got Warsh in charge and his alignment with the guys at Soros, dare I say that, Druckenmiller, etc., and Scott Bessent particularly, ex-Soros as well. We're going to see some sort of currency devaluation, either deliberately or forced, maybe a gold revaluation, but we're going to see some action on the value of the dollar pretty soon, and we've seen that already from financial markets.
Yep. You mentioned about the central bank and doing their job properly. And we saw a fall in per your release as well, metals, Bitcoin, stocks, etc. Are investors too dependent now on easier monetary policy?
Well, I think they have been since, let's say, 2009, particularly since COVID, because the Fed put is always there. We'll always bail you out by money printing. Warsh's history is he resigned because of QE in 2008, I think it was. So markets are taking that as we're not going to have any messing around with money supply. And, you've seen that the 2-year yield has gone up quite a lot. The 30 and 10-year yield didn't go up so much, so the yield curve has flattened.
Yep.
So although bond investors might like it, those whose market depends on liquidity didn't like it, obviously.
Yep.
Bitcoin, crypto being the first. Currently, gold is a risk asset, stocks, etc.
Yep.
So the immediate reaction was to sell.
Yep. So on that point with the long-term rates, is the bond market now a bigger constraint than inflation?
Well,
that's rather a tricky question. The bond market, particularly at the moment, is looking at Kevin Warsh aligned with the president and the Treasury and how they are going to address the debt of the nation, which is an incredibly complex matter.
Yep.
So
Okay.
I don't think you're going to get many investors in the long end, although Mike, should I say, might disagree with me. But certainly it's in the 2 years where any volatility is going to be, and we've seen it back up rates quite a
Yep.
lot.
Yeah, I think I'd agree with you there, Ian. I think overall markets are reassured by Warsh's election, and I think they've convinced themselves he's not going to be coerced by anything Donald Trump might want him to do. He's going to keep the Fed's independence. He's inherited an organisation that's missed its inflation target every month for the last 5 years, which I would say is pretty much a failure of Jerome Powell's tenure over that period. And he did, in the first press conference, emphasise this price stability aim, and that's what he's going to deliver. So I think that means that rates will be going up, putting pressure on front-end yields for the time being. We saw a positive reaction actually at the long end, which I think is needed. The markets need to see that the Fed are getting a grip on inflation in the short term for them to stop selling off. More the problem for me, as Ian alluded to, that the long end really faces challenges on the deficit side more than inflation, I think. We have governments around the world who are intent on spending money on wars or potentially spending money on defending themselves from other people's wars or splurging money on welfare and benefits, etc., as much as they can. And they're simply failing to really recognise the spiralling debt problems around the world, which will affect longer end markets. And I don't see that going away, unfortunately. The public don't want to hear about austerity anymore. They don't understand the problem. They want populist politicians who are just going to keep spending, giving them free stuff. And that, to me, is very bad news for the long end of bond markets.
Oh, wonderful. Excellent. Thanks for those comments, Mike. That was really interesting. One of the other things I want to touch on, Ian, if the US needs to lower rates to manage its debt burden, does a yield curve control become a realistic policy option?
Only way to do it.
Now, we've seen this happen in other countries too. Japan, Australia.
Yeah, it's happened in Japan fairly recently, but I mean, after the war, everyone used it. It's a well-known tool. But as ever, distorting markets just lends to an eventual crash. It's happened every time.
You also mentioned about gold and the gold price pulling back. Is this a buying opportunity or a sign that a macro hedge trade is losing momentum?
At Sabria, we're buying again. We were buyers from 1800. We didn't sell any at the top, fortunately, but we're buying again. We're adding to it now. It could go down a little bit more, but I think a lot of people are waiting for it to go down further. Kind of means that the dollar's got to go lower. Currently, it's moving higher. And we'll take a look at where the dollar is when we look at the charts.
Yep. Mike, was there any other question you wanted to ask before we moved on to those charts?
Yeah, I was just going to ask Ian generally about the dollar index, where you thought that was heading. You're alluding to the dollar's going to go a lot lower sometime. But it seems to me foreign exchange has been a bit of a sideshow compared to big up movements in equities and volatility in bonds. Dollar's not particularly done very much in aggregate. Yen weakness has probably been the biggest trend the last year or so. But any particular currency pair you'd be focusing on as a big mover?
Yeah, dollar yen and dollar Canada. But why don't we talk about that while I'm showing the charts?
Yeah, sure.
Sounds great. Wonderful.
Shall I do that now, Don?
Sounds great, Ian.
Give us a sec. You tell me when you can see it. All right, well, let's just go through left to right as usual. Bitcoin has had not a bad morning, in fact, and looks as though it's having a bit of a bounce. This is our new indicator that we designed in-house that you kind of have to know how it works to understand it, but that's what it is. We've just started buying Ethereum, very small amount, because at some stage all this tokenization of real world assets has to happen, and Ethereum's the only game in town, and currently it's been absolutely smashed down with the decline in Bitcoin and other risk assets, and is looking pretty cheap. But really not a lot going on there. It's just following other markets. Gold is nearly 30% decline, so we would need to go down to 3,900, let's say, to be rough, for a 30% decline from the 5,600 high. We've got a double bottom that breached it just here at around 4,100, and we bounced, and we're just trying to make a bottom here. Might have one further decline, I'm reckoning, but lots of people want to buy it now. Central banks are still buying it. It's just in the wrong place at the wrong time, and as we all know, that can change really rapidly. Silver's the same. It's got a double bottom here, like Bitcoin did, just being bashed as foreign powers have had to sell metals in the Iran war for liquidity purposes, buy more fuel, defend their currencies, etc. But as Mickey said, the game that is going to happen really quickly is in currencies. Like he said, it's been a sideshow because fiat currencies are relative rather than absolute, and the debasement trade that we put on in gold has been measuring the decline in the buying power of the dollar. So this is the Dixie, and it's a measure of the dollar against a basket of other fiat currencies, predominantly the euro. In the grey channel is a very long-term channel, which we'll see better when we look at the monthly charts, but you can see recently it's broken down, and it's broken down again, and it's come back up again, and we're challenging a short-term resistance level just over 100. We've talked many times about my old friend dollar yen. So we started buying at 140. It's now 161. All this at 160 has been central bank intervention pushing it back. He torched $75 billion 3 weeks ago, a month ago, here, and it's higher. So it never works. Don't brag about it. If you want to slow it down, that's fine, but don't talk about it in the press, otherwise all the speculators will be all over you. But the one I really love is dollar Canada. Look at that.
Wow.
What do you think of that, Mickey? Is it a shitcoin or?
Yes, well, I'm going to Canada, so I'll be able to comment more there. Yeah, that's quite a move.
So really, we're looking at a dollar that, looking at the monthly chart here, so this is going back to 2008. It's been in this trend channel where it's tried to break out, and now it's having a long formation of trying to break out. So this is a bear flag looking to break lower. Currently it's broken above the bear flag. Will that turn into a bull trap and it reverses and going lower? Personally, I think that is what is going to happen. But it seems that Mr. Trump and Mr. Warsh are trying to rescue the credibility of the dollar. Clearly, they need more than talk. Maybe a new financial framework, revaluation of gold, whatever it is coming, because it has to come at some stage, as Mickey alluded to, with the permanent debasement of currencies, and the debt and the deficits and all that stuff. But really, if this channel is truly broken, it's going a lot lower. So you pick your sides, I guess. Bond markets not doing anything. So this is probably the sideshow until it isn't. Didn't sell off with Warsh, although rates ticked up a little bit. Nowhere near as much as, so that's the 10-year US. This is the 2-year. So we've seen an increase in the last, since April of 370 to, let's say, 50 basis points, which is a big move on a total of 3.5. So we've seen a big move up. So the market is now pricing in 1 or 2 rate cuts in the near future. Whereas a year ago, it was pricing in a lot of rate cuts. Equity markets, this is SpaceX. 4 days of trading so far. Not doing too badly, actually, considering the hype. The Nikkei is going up. The FTSE is going down. Rumours today that Starmer's going to resign again. What do you think about that, Mickey?
I think it's almost certain he's going to go, or set out his plans to go this morning.
Yeah,
but Burnham will be coronated. I don't think there's any challenge to him from Streeting or anywhere else. So we'll have an Andy Burnham Prime Minister very shortly. What that means for markets, I'm very sceptical. He looks like the cool guy in the black T-shirt, very popular, very good communicator. But at the end of the day, he's a northern tax and spend socialist. I don't know how he's going to tackle our dreadful debt problems. And I also suspect he will call an early election on the grounds that he's got new policies, a new direction, and he'll try and form a coalition with the Liberal Democrats and the Greens to keep out Nigel Farage's Reform Party. So we could end up with 5 years of what I think would be a pretty hard left socialist government, which my personal view will be a disaster for the UK, and sterling will be down.
Nice choice then, is there? Disaster or an absolute disaster? Anyway, so gilts have actually been going down in yield recently as this has unfolded. S&P undecided at the highs, as is the Nasdaq. As you can see, we're forming a triangle here, a wedge, so we're looking for some sharp action fairly soon. So that's pretty much it from the chart. So I'll go back to the studio, as they say.
Yep. Ian, any other announcements this week we need to be aware of?
Economic data, PCE in the States, monthly PCE. Obviously, we're looking to see what Mr. Warsh is focusing on in terms of the number he's concentrating on to measure inflation. No doubt he will have his own, as they all do, cherry pick the one that's the lowest.
Yes.
Otherwise, economically, fairly quiet. Today, I don't even know what's happening with the Iran situation. I thought that they Iran walked out of the meeting in Switzerland, but it seems that they walked back in again. So
yes, they did. Yes.
What a complete and utter mess. Anyway, markets don't care anymore. No.
Mike, we've probably got time for one question, a very short one. So I'll ask if there's anything further you wanted to ask of Ian before we closed off.
No, I think we're okay at the moment. Just be interested in hearing what you think about the Australian economy as a slideshow there.
Yeah, so it's slowing down. I don't think there's much argument about that. We have a massive house pricing bubble driven by migration and lack of stock, which the government is fueling by their own stupidity. The recent budget introduces a whole slew of tax changes, which the public has, I think I'm safe to say, not liked at all.
Although they are not liked is a very kind word.
Yep. And they're now trying to unwind some of that because it hasn't been legislated yet, obviously. But in any case, they've already queered their own pitch, as they say in cricket. And the rise of a right-wing party, which has been hanging around for years and years and years and everyone's ignored, basically, suddenly finds itself right in the limelight. So I think we're probably 5 years behind the UK in terms of political stuff and economic stuff, which means the economy is going to get kicked in the head fairly soon, I suspect. We also have got, when does Labour have to leave, or when's there an election on? Is it 28?
It's probably about 28 because it was only last year. So when you think of their maximum terms, it'd be about that.
Yeah, and there's also a whole lot of stuff undercurrents around home ownership or land ownership, should I say, coming out of Canada originally, where some of the native inhabitants have reclaimed land that settlers took 250 years ago.
Right, yeah.
There's an undercurrent here in Australia. Have you been reading about that?
About the same, not in great detail, but it's been going undercurrent there for a while.
Yeah, exactly. So in Australia, I think that we put rates up because we put them down recently to start with, and rates will probably move up with the ECB and others putting rates up after the oil when oil doesn't fall as much as people think. But really, rates, I think personally, rates are going to come down a lot everywhere, by natural forces or not unnatural forces.
Yeah, I tend to agree. I think that's probably a story for well into next year, though. So and going up a bit in the meantime.
Yep.
Wonderful. Well, Ian, thanks. We might wrap it up there if that's okay. Mike, really appreciate your attending today, and appreciate the questions and your insights as well. Ian, thanks again as always.
No worries.
That's another wrap of this week's Limit Up podcast. This and previous podcasts can be located on the Siberia Capital website, or alternatively, you can subscribe by accessing the link at www.siberia.capital/contact. Thanks again, everyone, for listening in, and talk again next week. Thank you.
Thanks, guys.
Thank you. Bye.